Welcome back. I've still got Wayne McCurry, Momentum Asset Management, Glenn Silverman from Investment Solutions, and Paul Hansen from Stanlib in studio with me. And things are heating up in the studio. What about the fact that companies do have strong balance sheets? They've been holding on to their war chests and not deploying that cash. Could that not be a saving grace?
No, I think it's a very strong point that you make. I mean, I think the governments are the weakest part of the economy, consumers second, and the corporates are definitely the strongest. The question asked is why are they sitting on the cash? And I've come up with three kind of reasons, thought about this kind of long and hard. Number one, there's no investment opportunities. So that's not a good sign. Secondly, I don't believe they trust the banks. So they are their own bankers. They saw what happened in 2008 when lines of credit were pulled from them, and I don't believe they're prepared to go through that. So I think they can read the writing on the wall. And thirdly, in particular states, I'm not talking about the South African companies, they can't bring the money back. Most of the money sits overseas, and in terms of they would pay these huge taxes in repatriating money. So I think somebody is kind of trapped. Obviously, to the extent tax laws would change in America, that money could come back. So yes, it gives them strength, but I think it is a sign of weakness, a sign of concern that they look at this environment and they refuse to invest it, and they probably can't.
Well, there's your glimmer of hope smashed to smithereens.
Not at all. It's huge potential for spending, massive potential. Here, watch, for example, Transnet going out and spending 500-600 billion or whatever it is in the next 4, 5, 6 years. That's going to encourage companies to take cash and go and build, because now you've got a railway line that you can put your iron ore and your copper and so on, and your coal. So, we're moving in the right direction. Huge potential for spending. But we're just talking here.
Do you believe so, Wayne?
Look, it's a very unfortunate thing to say this, and I hope that I'm wrong, but all of this Transnet capacity is going to come online probably at the time when no one wants our commodities. But that's another story.
Don't get too depressed on this day, please. We've got to have a show tomorrow.
Look, you must remember that a sustained bull market occurs with two things must be in place. You must be cheap to start. There's no bull market that's ever started from an expensive level. You've got to be cheap enough to start, and you have to have, most likely, a good economic environment, but at very least, a reasonable economic environment. And quite frankly, our market as a whole, those two conditions aren't present. And they're not present in Europe, and they're not present in the US either. So, I mean, do you buy a US long bond at 1.5% now? And taxed on it, or do you buy the S&P 500 at a 3.5% dividend yield? So forget the capital values. On a running value, you probably still want to have shares in your portfolio, but Glenn's right, returns, unless you're really good, returns are going to be depressed for a while.
All right, so let's break this further. You've both mentioned resources, all of you have mentioned resources, BHP, Anglo American. If you look at those stocks, with your pessimistic view, the bearish stance that you've taken, what would you be doing with BHP and Anglos right now?
So again, I'm not a stock picker, and we don't analyze underlying shares specifically. I look more to what the managers are doing, and our managers are buying them aggressively, and have been for about 2 years now. So we have to say got in a little bit early and continue to do so. So value, I think, is obviously, as things go down.
So they're seeing value in these
definitely,
stocks.
And seeing more value now than they did 2 years ago, because these things are cheaper relative to the market, and many times cheaper than in absolute terms as well. But I think if we have a very bleak global economic backdrop, if we have some concerns about sustainable investing environment, these other issues I talk about, which people poo-pah me on, but I will continue to beat the drum. We need to take these into account, and I continue to present on it, and hopefully some people are listening. I think there are some concerns out there, so I don't dispute the cheapness thereof. I think, especially when things get too cheap, I agree with Wayne. But I don't care about a bounce. A market that bounce, can they sustain it? Do you look a year later and say we're up or down, and 2 years later and 3 years later? And on resources, there's some question marks around China and other stuff. But against, for example, South African industrials, I think arguably expensive across.
So have you been singing this tune with BHP and Anglo American for the last 2 years, and they've just been getting cheaper and cheaper?
No, we are underweight resources at Stanlib, and we think they're pretty good value. But we've been underweight all the way through, because if you look at this financial industrial chart, the index.
Okay, well, where are your graphs?
Resist punting his own
No,
fund.
this is not the Stanlib
This is a Stanlib fund.
This is not the
It's
Stanlib
the
fund.
Stanlib Industrial
okay, I
Fund.
thought it was
This
a
is the
Stanlib
financial industrial index of the JSE.
You are shameless.
You are
Absolutely
shameless,
shameless.
No, this is 28% higher than the pre-crash peak there. The financial industrial index has a magnificent bull trend. And I'm not saying that, that
He's hijacking the show. Glenn, whack him over the head.
You warned me
his
not to,
graphs
but you also
down.
promised not to show that graph at the break. So I don't know.
You're absolutely
getting
out of control. I think that's it.
invited
You're never
back.
coming back into the
No,
studio.
no. Look, in investment, you got to have bulls and you got to have bears. If you only employ like-minded people, you will be very right half the time and very wrong the other half of the time. So you got to listen to both viewpoints.
Is the end of the
Well,
world
sorry.
coming?
So probably not. I don't think the end of the world is coming, but I think a new world is coming. I hope a new world is coming. I want to just tell you something. When I would start to get a little bit more positive is when proper action is taken. So if they come up with another acronym, you can write me off and just take me out of it. I'm just going to come back here and just repeat what I have. If we want to sort out some of the debt problems, if one wants to reduce the percentage that government as a share of the economy and put incentives to small business to grow, and I don't think they can cut interest rates anymore, so we can take that off the table. I think if hard action is taken, I mean, I still love the euro and discussion around Greece. If Greece is the pimple, if it's 2% of the euro region, then why is it causing so much trauma? I don't think anyone cares. But it's about Spain and Portugal, and so it goes all the way up the chain. So when action can be taken, when politicians can step back, when we, I guess the public, can vote politicians in, they can, leaders, they can take some tough decisions, then I start to feel a lot more happy. Even in fact, if the news gets worse. In fact, sometimes a deep recession cleanses the system.
A deep recession cleanses the system.
I
Come
would
on,
ask you
respond to that.
just, I'd like to see these things simply. It's such a complicated world out there. You can get caught up in the complexity. The simple question is there more good than bad right now? Looking ahead, looking forward. I don't see any reason not to believe that. There
Can
is
you
more good than
categorically
bad.
say there's more good than bad? Because I don't think you
Looking
can.
ahead in the next 12, 24, 36 months, more good than bad by quite a long way, by a mile.
Well, Mr. Silverman doesn't agree with you.
No, across the board, I think that's exactly wrong. I mean, I think every example I could think of would probably talk to opposite. I've used this before. The US fiscal cliff that we face at the end of this year is really dramatic. We could have anything up to 4% of the US economy come out, and it will come out. So in other words, there are guaranteed tax reductions of equal to 4% of GDP coming out unless somewhere between the end of November presidential election and the end of this, Christmas or beginning of Christmas when they go and leave, they come up with something to kind of avert that.
Or before then.
Well, it's highly
They're working on
unlikely.
it. They're working on it.
Yeah.
Okay, it's possible, but I think highly unlikely considering the acrimonious debate we've seen thus far and a presidential election to come that they're going to get together and shake hands and hug like you and I. It's unlikely.
I
Except
don't know if we're
after
ever
the
going to
show.
see you two hug. Let's hope
They're
not.
good friends. Now, look, politicians will always take the easy route out and transfer the problem to tomorrow.
Yeah.
That's what politicians do for a living, but let's not worry about that. Look, personally, I think we're over the worst. I think the moment psychologically, or whatever you like to put it, Germany took the decision to bail Europe out, I think that was the tipping point. And maybe the tipping point in China was last week when they decided that, the economy is slowing, we're cutting interest rates. But I cannot get bullish about things just getting dramatically better. I can't. But I'll say one thing, and it might take 20 years, might take 2 decades for this thing to be sorted out. But this is probably the end of the welfare state as we know it in the Western world, and people are just going to have to work harder for longer to get
Which
themselves
goes back to
out
the
of
new
the mess.
world, the new world order
But these are
that Glenn put on the
decades.
table.
These are because, as Glenn quite rightly said, as people become more productive because the government's not going to look after me anymore, government debt has got to get repaid, which is a major suppressor of growth going forward.
Yes, Mr.
I
Hansen.
just want to point out that while the MSCI World Index has gone up 72% in the last 3.25 years, $1 trillion has been moved out of equities in the US, $1 trillion, into bonds. What's going to happen when that reverses, when that $1 trillion comes out of bonds and goes into equities?
Bondholders are going to lose money.
Yeah.
And equity holders?
I don't know.
So, I mean, at the end of the day, I say the following, it's not absolutely clear to me it has to go to equities, but I do agree that that would be the single most bullish argument made. That at some point in time, if people panic out of bonds into equities would be good, but if they panic out of bond into cash or into gold or out of the system, I don't know. It depends what makes them panic. So I don't know. Bond yields in America, Wayne, went to 5% plus, let's say.
We are 4-5's the norm.
4-5 the norm.
And they had 1.5.
In that phase, normally equities don't do so good. You normally have this kind of sell-off as if it's an inflation fear, for example, that drives it. Much worse if it's a default fear. I mean, what would make people pull out their money out of bonds? We need to think about that as well.
And that's a question for another day. Unfortunately, we run out of time. We have to leave it there, gentlemen. Thanks so much for your time. Glenn Silverman from Investment Solutions, Paul Hansen from Stanlib, and thanks very much to my guest host, Wayne McCurry, Momentum Asset Management.